Good evening or good morning, depending on where you are in the world, of course. My name is Kyle Rodda, and I'm with Danny Haythorne. We are both senior market analysts at Capital.com, and this is the Market Monday webinar, of course. Danny, good to see you. Obviously, we can see that you're actually we can't see this. I know this, but you're in London today. How's it all going?
Good morning, everyone. Yes, I am currently in the Capital.com office in London. It's good to be here and ready to start another week in the markets. Bit of a different week this week with all of the issues going on with the blackout, which we'll talk about in just a second. But of course, we need to get through the typical uh, risk warning. So you want to take it away?
Indeed. Yeah, I'll fire off very quickly. And that's just to say that anything that you hear here is of general nature only. It does not take into consideration anybody's personal circumstances. So, of course, do your own research and consider your own risk appetite before trading CFDs or acting upon any information that you hear here. Um, Danny, you've got something to sprinkle in as well.
Yeah, just to be aware that, of course, the products that we offer at Capital.com, which are CFDs, and for those of you in the UK, also spread bets, are risky products. Just make sure that you are aware of the risk and understand the nature of these products before trading them with Capital.com and that they are appropriate for you.
Indeed. Okay. Well, we'll crack on. We'll sort of talk about the US government shutdown and then perhaps everything that's happening at the core of the US economy at the moment, because I suppose the shutdown is something that sort of occurs at the periphery. But I'll touch maybe on a little after that as well, just what's happening in Japan and Japanese markets specifically today. I think we've obviously, well, most of us have seen the news probably already. And then we'll look ahead to what's coming up, and there could be either quite a lot or there might be actually very little, depending on whether this shutdown persists or not. But I mean, Danny, maybe I'll take things to start with very quickly with a comment on this kind of shutdown situation. At the moment, it's dragging on for what, 4 or 5 days. I think we're into it now, maybe close to six by the time my tomorrow rolls around, so to speak. But the markets have more or less looked through things, and if you do look at sort of historical precedents here, the markets tend to do this. The 2018, 2019 shutdown resulted in the S&P, well, not resulted, but saw the S&P 500 climb by 10% at the same time. And the real concern only really seems to be that, one, we are getting pretty much the light switched off at the BLS and other major bodies responsible for obviously some key economic data. And then there's this other fear as well that maybe there might be some permanent layoffs here announced by the Trump administration, which could turn a temporary thing into something a little bit more lasting. But as we can see already, as we just sort of flick open the Capital.com platform, looks like Wall Street's going to open basically at record highs today. So looking through some of the drama.
Yeah, I think, look, when it comes down to it, the shutdown shouldn't affect the the US economy at its core. If it does extend for a long period of time, let's say over a month or two, we do have potentially a little bit of an impact. I think the last time it was forecasted it was impact 0.3% of GDP. So it can have a lasting impact if services are interrupted for a long time. But I think markets are not really focusing on that right now. I think it's more the inconvenience of the services being not providing the kind of information that markets want right now. And that is, of course, economic data that is going to impact or determine the FOMC decision at the end of the month. So not having the jobs data on Friday, that was a nuisance for markets. And there are other key releases that could also be pushed back or cancelled if the shutdown isn't resolved soon. So markets are going to have to rely on private data, something like the ADP jobs data that was released last Wednesday. And they're not always the best reading of the situation in the US. A lot of the time, the ADP is a little bit skewed. In fact, there does end up being some sort of a correlation when you look at it over a longer term period. Let's say when the official jobs data sometimes gets revised, and we do see that fall in line with the ADP. But on the preface, markets tend to kind of discard the ADP data to focus on the actual data that comes out, the official data that comes out 2 days later. We haven't had that this time around. So markets may potentially take in a little bit of information from that. However, the data we saw last week, that ADP data, if I remember correctly, something like minus 50,000 jobs for the month of September. So that was significantly lower than what markets were expecting from the official jobs data, which I think was actually plus 50,000. So there's a big difference there. And if that data does end up being true, it is quite disappointing, or I think it gives a bit more of a picture of a weaker jobs data, more than markets were already pricing in, given what we've seen in the last few months. So that will affect the FOMC meeting. And I know some of the members have come out and said in the last few days that they don't focus on just one reading, they take it over a period of time. So if they don't have the data for the last month, although not ideal, it doesn't necessarily mean that, you know, it's gonna interrupt their decision making. However, it will impact market pricing. And of course, we've already seen the expectations for a rate cut at the end of this month have increased slightly. But not only that, we're now back into pricing, even if very minimal, we're back to pricing a small chance of a 50 basis point cut at the meeting on the back of that worst ADP data. So again, we're just flying a little bit in the dark. It just markets, I guess, are just now scrambling for what to go on, right? And that's going to be private data and of course any commentary from FOMC members.
Yeah, you did see that big move obviously last week on the back of the ADP figures. That, like you said, Danny, was that kind of surprise contraction. And I mean, I'm just sort of perusing what the Fed Watch tool says now. 95% chance basically of an October cut, and 80, what's that, 5% chance of a December move. And I think, it's kind of curiously as well is that we've also got markets basically pricing in that the trough rate this cycle will be below 3%. So there's a real expectation the Fed's going to cut pretty aggressively here because, I mean, there is the hope that with growth clearly picking up, compared to previous quarters, that maybe the labor market slowdown will ease itself in the next few months. But certainly, there is a sense that the labor market warrants a few rate cuts to kind of support things and keep it sort of adding jobs. And that's pretty much seen again these kind of really aggressive moves being kind of discounted into the price. But I mean, I kind of figured as well, just given there is this kind of variability as to what we might get this week. I was just taking a look at the week ahead just on Forex Factory. You can kind of see there just the number of data releases already in what would otherwise be a pretty quiet data week. Is we could either get, if the shutdown ends, say in the next 24 to 48 hours, or we might not get it all once again. But we've got this like real backlog of information now that the markets are sort of waiting for. That to an extent we're sort of more or less kind of flying blind a little bit without this information.
Yeah, so I think it does come to a fact of the uncertainty right now is when are we going to get this information? I think markets, and you said, look, US equities are expected to open breaching those all-time highs that they've been pushing to in the last few months, sorry, the last few weeks. Sentiment remains strong. The only issue now is that sentiment going to be able to build higher? And it's hard to justify that when markets are, as I said, kind of flying a little bit in the dark. They're just going to rely on headlines. They're going to rely on commentary. They're going to rely on private data like sentiment data in the economy and from businesses. So it's not concrete data, it's still something, but it's now a question of when is this lockdown going to end? If it's the case of it ends this week, it ends in the next few days, then I think all will be forgotten and things will resume back to normal. It's just a case of then waiting for the actual jobs data, the NFP data on Friday. If that matches up with what the ADP has been pointing out, then that's potentially when you see another bit of a reaction in the market when it all kind of converges. But it's just a case now, it's really hard to talk about what comes next, what's going to happen when we don't really have any timeline of what exactly are going to be the key catalysts in the market. So I guess for those of you trading or interested in US equities, just watch out for headlines, watch out for any news on potential of unblocking of the US government, and just watch out for when the next data releases are going to happen. Technically, we are pretty much similar to where we were last week, still treading into that overbought region. Equities are expensive. Valuations and fundamentals are backing up the price, but they are still expensive. And I think hard to justify for new investors to come into these levels without any backing that the momentum will continue. And of course, we just don't have that right now. So maybe it is a little bit of time of a pause and reassess, but I don't think the momentum really changes that much unless we have concrete evidence to point that way.
Yeah, so we'll wait and watch until we get that data, and of course we get earnings in a couple of weeks as well, really starting to pick up. So that'll provide us at least something substantial that the government can't necessarily withhold from us. The US government can't necessarily withhold from us to sort of discount into the markets. But I mean, maybe we'll just take a bit of a look at what happened in Japan today, Danny, just because it's such an extraordinary move, and we've still got the Nikkei up by about 4.7%. And it looks like it will have ramifications for the rest of the world. Just to give a bit of a summary, effectively, the new LDP leader is considered a fairly pro-stimulus presidential, prime ministerial, I should say, candidate, and has flagged pretty significant spending on strategically important areas of Japan's economy, like semiconductors, nuclear energy, artificial intelligence, as well as tax cuts for households and handouts as well. And it's manifested in this kind of dynamic where the fiscal impulse in Japan is still pretty strong. You've still got inflation, core inflation in Japan at about, I think, 2.7% last time I checked. And we did have a speech by Governor Ueda on Friday, and while he kind of he drew he drew on the same kind of talking points as the past, which was to say that, rates will get hiked eventually, but did not provide much of a specific timeline. And it just doesn't seem like despite inflation remaining above target. It has come off the peaks of the last few months, which was above 3%, but still inflation is above target, is likely to see these kind of significant tailwinds coming through to prices over the next few months. They just haven't really mustered the courage, perhaps, to flag imminent rate hikes. So you've pretty much got this melt-up scenario happening in Japan, Japanese equities. We're up by about as much as 5% at the open today. As you can see here, a huge gap at record highs, and at the same time, a pretty significant sell-off in the Nikkei. And some people might sort of ask, well, why is the Nikkei, sorry, why is the Japanese yen, I should say, uh, dropping despite the fact that we're getting all this stimulus coming through? There is really these concerns about real yields specifically, and fiscal sustainability in Japan with all of this kind of money potentially going to hit the economy, that you've got more or less traders selling the yen on the basis of that. And it's a sort of a really interesting kind of a dynamic that you can see in the Japanese yield curve as well, where you've seen a pretty significant drop at the front end of the curve because Takaichi is a major sort of policy dove when it comes to monetary policy as well. But the back end has jumped significantly, about up sort of 12 to 13 points on their 30-year yield, which I think is the highest since 2008. So you've got, the yen at this really crucial level too. And it's also had the effect this morning as well of pushing gold to fresh record highs. It's really caused this, huge melt up in markets. Again, someone out there, I don't know who it was specifically. I heard it on Bloomberg today calling it the debasement trade, just because governments are sort of throwing themselves at further fiscal support, or throwing further fiscal support at the economy at a time of already high inflation and already very high debt levels. And it's causing, this significant run that we're seeing in gold, which is really only, it's not far from $4,000 per ounce, which is extraordinary. Basically, at levels, on the RSI that we haven't seen since probably even before October 7 a couple of years ago, when we did see that really big run when there was the attacks there, obviously in Israel. So it was actually quite a remarkable start to the session this week, Danny, and it could have global ramifications if there is a view that Japan is going to basically run its economy really, really hot.
Yeah, I think there's been concerns around, about that, but they've more been lingering concerns. I mean, we kind of used to seeing Japanese officials be very reluctant with hiking and tightening the economy because of the struggles they've had in the last decade or so. However, the new appointment does seem to add a new layer of complexity to that, and further another hand of easing or ultra loose monetary policy could affect those real deals, as you said. So of course that's one leg higher for gold. Gold has just been the place to go right now. I mean, if you're looking at political uncertainty, if you're looking at global instability when it comes to conflicts, if you're looking at economic instability, all of that that's been going on with the US shutdown, with ongoing wars, with concerns about the economy, concerns about how inflation and growth are interlinking in different countries. Gold has been the one place that has been attracting buyers on the back of that, whether that's portfolio diversification, whether that's just straight up buying gold. We've just seen this continuous upside in the precious metal. Fundamentally, we've been saying this for a long time. The long-term momentum remains unchanged. Central banks are buying gold, shifting away from the US dollar to some extent as the global reserve, as the key asset held by central banks. And we're now seeing that move towards gold, pushed primarily by China. But of course, that's been driving precious metals higher. The same with silver here, as you're highlighting, an incredible run for silver. On top of the precious metal and safe haven aspect that silver has, that we've just been talking about with gold, it also has the industrial application side of it, where it is used increasingly nowadays, specifically with a lot of the electric vehicle industry and manufacturing. So there's been an increase in demand for gold in for silver in industrial processes. However, supply is limited. There is a limited amount of capacity and extraction. Silver is often a byproduct of other mining industries, and there hasn't been investment in the sector in a long time. So we're now at a point where a lot of forecasts are showing that there's going to be a severe undersupply of silver for the amount that's going to be used in production in the next few years. And that has been also driving the price of silver higher. And also fundamentally, that remains a key driver into the future. So even if we do see short-term wobbles on the back of headlines, whether it's geopolitical headlines, whether it's economic headlines, the long-term fundamental for silver also remains pointed to the upside on the back of that shortness in supply, and that's kind of driving prices higher. So Kyle, I don't know if you have anything more to say about gold and silver.
Only to say with silver, just because, one of the interesting elements today is that, obviously, the Japanese government is, I mean, the thing is with Takaichi is that she's, sort of considered this nationalist and defense hawk, and wants to spend a lot of money on basically ensuring that um, Japanese has a degree of sort of independence, both from a defense but also sort of a manufacturing perspective, that a lot of this public money is being earmarked for things in which silver is going to be a component. And that's the same thing when it comes to, what's going on in the United States at the moment. Even a few weeks ago with, what happened with Nvidia and OpenAI and Intel as well, and Oracle, that kind of circular kind of economy that's being sort of developed there, but between the relationships with those companies, is that a lot of this money being sort of earmarked for investment is going to have a significant impact on the demand for silver as well as an industrial metal, like you said. So all of these things are conspiring in this really perfect way for silver to rally from both the perspective of being kind of a precious metal, looking to sort of help investors diversify from, maybe government largesse, but also, the fact that a lot of that largesse is going to be expressed as, public money going towards things, going towards, wanting to snap up, like you said, this kind of dwindling supply of, or at least shortfall of the metal. So yeah, really, really interesting one. Another one just to keep an eye out for, because it's absolutely melting up. It's ripping. It's making you think that this has to pull back at some point. But at the same time, there's a signal there, and the momentum is extraordinarily strong. And there's a lot of people that would have been trying to short this on the way up that would have had their sort of obviously had their fingers burnt, so to speak. Um,
Indeed.
but yeah, we'll move on. What next, Danny?
Well, I just want to say it's not a market that we often touch up. If you want to just pull up the CAC 40, which is the French index, because there has been a story this morning breaking through. It's still very much unfolding, so I don't have all of the details, but we have seen coming through the headlines that France's Prime Minister, Sébastien Lecornu, has resigned. And this is, I think he's only been in cabinet for less than a month, 26 days or something like that. So this is another leg in the French political drama. I'm not sure everyone has been following, but France does have an issue, a political issue. They have an issue with actually keeping governments in place. Ever since we had the the issues with Macron and his, the loss of confidence in the government, there has been a rotating prime minister coming in. This new one had only been appointed at the beginning of September. And if you put on the daily chart, Kyle, you'll be able to see that the CAC is down about 1.7%, I think, this morning, just after this news came out. You can see pretty much undoing the gains that we saw all of last week. So again, maybe not a market that everyone follows closely, but I do wanted to touch upon it just for everyone to be aware that this is going on. We may see some volatility throughout the day. It looks like the initial reaction has already been priced in, as you can see. As I said, we don't have a lot of information yet. Apparently, it seems to be that they had some kind of disagreement. I think I'm not sure it was with budgets or some sort of policy, and he has actually decided to resign himself. The previous prime minister actually got ousted out by a vote of no confidence. But again, it just highlights the fragile situation in France when it comes to the political situation. And again, Macron is now going to have to try and find a successor to try and sort out a lot of the issues that they have, fiscal issues in France. And obviously, it's proving to be a hard job. And that, again, provides more insecurity and more uncertainty to French markets, because it just seems a case of it's really hard to get a prime minister to actually be able to make a difference in the job. So we're not only seeing it in the CAC, but we're also seeing French yields driven up this morning, of course, as markets are now pricing in that higher risk premium because of the uncertainty in France. And also, if we're looking at the euro, a lot of the story on the euro on the downside here, likely on the back of the upside that we're seeing in the US dollar. Of course, the Japanese story is really helping the dollar index this morning. But in general, if we're looking at the dollar, it seems to be pretty strong. I believe the index is up about 0.75% this morning. We're seeing cable, so the pound against the dollar down. We're seeing euro dollar down, and we're seeing obviously dollar yen higher. But the French story is likely driving some weakness in the euro as well. So it's not only the dollar index, which of course, as you can see here, is pushing higher. I do also think that the instability in France is seeing some weakness in the euro this morning, because it's not an isolated incident. I think France has the worst case scenario right now, but we have seen a lot of political instability elsewhere, in Germany, in Italy, in Spain as well, and that does cause a little bit of jitters in the risk premium in Europe. But yeah, so it's something to watch out for. It will be unfolding throughout the day. Maybe the initial reaction is all we get, but I do think we may still see markets react a little bit as the day goes ahead and more news filter through.
Yeah, for sure. And just to make a quick point, if you do have any kind of questions, there's a question box that you can add your questions to, and we'll respond to them very shortly. I can just see that a few people have popped their hands up. But the dollar's going to be an interesting one too, Danny, because it looks as though that it might be showing signs of a pretty formidable turnaround fairly soon. And I've been sort of fairly bearish on the dollar for most of the year, but it really does look like that maybe that 96 level there marks a bit of a double bottom. And if we start seeing the momentum really pick up to the upside, that sort of raises the question whether, all that bad news that we have on the US economy and all those reasons to sell the US dollar this year from what was, levels that were, it was really hot coming into 2025, whether that story is starting to turn around. And, arguably you can make a case that we're starting to see that kind of bottoming out process unfold, a bit of a divergence there too on the weekly RSI. But just keep that in mind, something to sort of follow over the next few weeks. Maybe before we get to questions, I'll just quickly touch on crude oil, just because we did see a bit of a pop at the open for West Texas Intermediate after what was some fairly interesting moves, I thought, last week, just because we broke through what I thought was a pretty key level of technical support at around 61.50. And the lion's share of that was driven by the speculation about what OPEC would do over the weekend. And there was the sense that it was going to lift output, but some of the numbers being thrown around before the actual JMMC meeting were pretty extraordinary in the realms of like 400,000 barrels per day or things like that. And the things with OPEC is that they often sort of leak these sorts of things and let off these kind of trial balloons just to see how the market will react. Anyway, we did see that kind of breakthrough, sort of again what I thought was a pretty significant support level at about 61.50, and conceivably could see sort of things open up a little bit further down to sort of $60 or so. But output hike for November was only 137,000 barrels per day, which is only a couple of thousand barrels more per day than what they hiked things by in well, for October. So we're seeing a little bit of a bounce there in oil today. I still think that ultimately the kind of supply and demand imbalance wins out. And this glut that we've effectively got building because of an OPEC that is, as I've been sort of phrasing it, prioritizing, market share and volume over price and revenue will put downward pressure on oil prices. But nevertheless, we have seen a bit of a pop this morning. And we've got, well, the 200 day, I think that's the 200 day moving average at around sort of $65 per barrel. So maybe we see a little bit of a reversion this week. We'll see how things play out, of course. I don't know if you have anything to add there, Danny, or you want to tackle the first lot of questions if we happen to have
Yeah.
any.
No, I don't have anything to add. Oil's definitely an interesting story. We do have a question, one that's maybe not so markets focused, but the question is simply, why do we have a US shutdown? We aren't political analysts, but on just the very simple explanation is that Congress simply didn't pass a new spending bill by their deadline, which was on October 1st, I believe. So they essentially have to shut down essential services until Congress can approve funding and the president signs it. So that essentially means that non-essential operations within the federal mandate get stopped. So 100,000 workers essentially are on furlough or are told not to come into work, essentially, I believe, without pay. This is actually more common than you would think. It happens every 5 or 6 years or so. As we said earlier, the last one was in 2018, 2019, and there have been a few before that in the last decade or so. And it's simply a case of reaching the deadline for the funding to be passed with disagreement, and the political parties have to work it out. Sometimes it lasts a few days, sometimes it lasts a few hours, sometimes I think it's lasted up to 35 days or over. So it's just a question of how long is it going to take them to work out their differences. Essentially, these workers that are now on furlough or kind of lost their job, it's not expected to be permanent. It's just they're not needed right now because services have been interrupted. However, as soon as services resume, all of these people will have their jobs back. So that's why we say that it doesn't usually have a long-term impact on the US economy. However, as Kyle pointed out earlier, Donald Trump has threatened to make this layoffs permanent, and that is potentially where we see a little bit of risk coming through. If services were to continue, even if these layoffs were permanent, these positions have to be filled again. So again, the long-term impact is likely to be less severe, but of course it is a risk, added on risk. And essentially that's why markets are kind of blowing it off for now, because they expect it to be resolved pretty soon with no lasting impact on the economy. It's more of a nuisance and a hassle than anything else at this point.
Yeah. So yeah, that ends. Data comes out again, and then we have lots more information and a lot more to talk about. Is the hope the resolution that we're hoping for. But that's pretty much it, I think, Danny, in terms of questions.
Yep.
And we're pretty much within seconds away from the 30-minute mark, so we may as well wrap it up there. But thanks for joining us another week. Of course, we upload this onto YouTube after the live version, so please watch and share and tell your friends and come along again. Provide feedback if you like as well. But otherwise, Danny, I think that's it for another week, and we can sort of crack on as usual.
Yeah, we'll be back here next time. Sorry, next week, same time. So make sure to come back and tell your friends to join us as well.
Wonderful. All right.
Guys,
Well, great week.
bye guys.